Hello, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Today we're going to talk about SPACs. And the reason why we're going to talk about them is that last week we talked about IPOs, and it seems that these SPACs are becoming more and more prevalent in the news. And so we wanted to discuss them as well.
Yeah, and so this is sort of going to be a question and answer session here because I think Laura knows a lot about SPACs, and she quite honestly knows more about them than I do. So I'm going to actually ask her about them. I'm actually going to act as if I were the viewer. So Laura, what is a SPAC, and why should someone even consider investing in it?
So a SPAC it's an acronym. It stands for Special Purpose Acquisition Company. And it's essentially, a lot of people call it also, another term for it is called a blank check company. And they're essentially companies that are shells. And so a founder will start a company.
Laura, that sounds scary, a blank check company.
Well, there is some scariness to it, actually, more so than I think people talk about. Generally, the founder will start a company and they'll take it public. Strictly, it has no operations. It's just a company that's intending to buy another company, and they'll get investors. Usually it's an individual who has a really good reputation in that particular industry. So maybe it's a SPAC that's targeting perhaps technology companies or maybe even green energy companies or that type of thing, but they're targeting specific industries, sometimes specific geographies, and they open the SPAC based upon their reputation and attract investors based upon the reputation of their ability to identify new nascent companies who have promise.
And so Laura, last week we spoke about IPOs, and would you consider them to be riskier than IPOs or less risky?
Well, okay, so a lot of people will say that they are not less risky, but I think that they are for a couple of reasons. Well, first of all, I should mention that the reason why you're hearing so much about SPACs in the news right now is that 70% of all companies going public in 2021 are these SPAC companies. So it's really an alternative way of taking your company public. And the traditional way of taking a company public, and the reason why I know about this is that years ago, I worked as a CFO for small businesses in Manhattan and actually helped a couple of companies go public. And it's a lot of work. It takes a lot of work. First of all, just getting all your financial statements in order, getting all your information about the management team, about your products, about your pipeline. It takes a lot of focus away from the operation of your business to now create all the documents that the SEC requires you to file. So it's a very tedious process, but in that process, it does force these companies to really think out where they're going. It forces them to disclose everything that they're doing to the SEC. And generally, the companies need to have some type of proven track record. Usually there is some, at least initial profit. Usually the investors will look at something called EBITDA. You may have heard that term used before. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's essentially free cash flow. And so the investors are normally looking for some type of cash flow that's being generated from the profits of the business. But with a SPAC, not necessarily so. What they're doing right now is they're looking at a lot of really, really early on businesses that don't have a track record, haven't actually launched out of the gate yet. And their hope is that these companies really are the future Apple, Google, whatever.
So I always like to break down any investment into what are the interests of the people who create the investment and what are the potential interests and benefits of those who might invest in it. So why don't we talk about how it would benefit the creator, these SPACs.
Yeah, so the creator, this is a big payday. The creators essentially get equity in the business, and they'll put very little seed capital up front to actually start the IPO, but then they'll claim usually oftentimes up to 20% of the overall value of the company as time goes on. And then if they get investment bankers involved, they take their cut, and usually that's somewhere around the 10% mark. So all the people that are in on the ground floor of this SPAC certainly are compensated very, very well. How, I know you're going to ask, Steve, how is the individual investor compensated? Well, the individual
That's
investor,
right.
the retail investor, when they get in, guess how they're going to eventually get compensated?
Hmm.
They're going to get compensated if the business is truly profitable. Once the business demonstrates that they truly are a going concern and they are a profitable company, and it starts trading in the secondary market on the exchange, that's when they start really seeing their profit. But anywhere in between, there's a problem. And you know what, Steve, you mentioned that you were asking about the risk. One of the biggest things that, biggest issues that I have with these SPACs is that with individual IPOs, the SEC specifically requires the executives of the company to have something they call a quiet period, which is essentially the time when the IPO is launched. They're supposed to be quiet. They're not supposed to be telling anybody about their company. They're not supposed to be promoting it. That's not what goes on with the SPAC. Because the SPAC is essentially, it's a merger. The SPAC,
Right.
what happens is this shell company goes out, and they have 2 years after they become public to find a target business that they want to merge with. And by merging with that business, they essentially bring it public.
Yeah.
So
Correct me if I'm wrong.
sure.
Correct me if I'm wrong, but it sounds as if what they do first, they create this shell, they look for financing from individuals, potentially, who want to invest, and they're going to be investing in what's quite honestly an empty shell at the beginning, purely based on the reputation of the people creating the SPAC, and then they're going to look for targets to acquire.
Exactly. Exactly. So you don't really even know exactly what you're investing in as you're investing in it. Then once the target company is being identified, these target companies are not being held to the same restriction of this quiet period. And what we're seeing is we're seeing a lot of them are out there promoting their business, marketing their business, and even sometimes projecting rapid growth and billions of dollars in revenue. And they really are potentially that they're potentially going to have a big litigation problem if in fact those projections don't come
are
through.
not met. Yeah.
Right.
And
that's
so we know there's regulation around IPOs. They have to, there's documents that have to be created, there's offering documents, there's reporting to the SEC, and other areas of regulation. Are SPACs regulated the same way, Laura?
They more or less are. I mean, they do have to file the same type of documents. I think that the whole marketing element is one of the loopholes that occurs. But the other side of it, though, as well, is when you're taking a business public. I remember spending nearly 2 years taking a company public. It took a long time to gather all that data, to gather all the information.
A lot of number crunching.
It was accurate. Yeah. With a SPAC, when a SPAC goes out to buy this company, they're usually going to be in much more of a hurry. The transaction usually happens within a couple of months. So you have to wonder how accurate is the data, how really well thought out has it been developed?
Yeah. Is there any research showing the success rate of SPACs and how investors have actually done with them?
So I have not really tracked any of it in any kind of methodical way. I can tell you that most recently, so SPACs were originated in 1993 by an investment banker. In the 90s, they did very well. And that's where I first learned about them, because that was when I was actually out working more in the corporate sector. Then the market had issues in 2021, if you recall, and they kind of disappeared. Yes. And then in the 2000s, they started to emerge again. And then when everything started falling apart in 2007 and 2008, they kind of disappeared. And now they're emerging. It seems like it's awfully coincidental that they emerge at the time where there's so much capital out there looking for a place to invest. And things are so frothy. To me, it's almost a harbinger, if you will, of the fact that maybe we're in a place where there's just a little too much money, a little too much freedom going on, that people can get themselves into a lot of trouble.
You know, it's almost a sign of a bubble potentially, and we saw something similar in the housing market in 2006 through 2008. There's a lot of capital attracted to real estate as an investment, and it drove the prices up. So it's possible we could be seeing the same thing here, right?
We always tell people our crystal ball is broken. So just kind of gut intuitive feels when you've been in finance for as many years as we've been in. Some of this seems to, you feel like almost deja vu. You've seen this story before. And the only thing that we can continue to tell our investors is, again, it's all about diversification. It's all about having a well thought out strategy, making sure that what you're invested in is investment quality and has a proven track record. And that's why I don't think we would ever recommend anybody to invest in a SPAC or an IPO, because they both are they're too speculative. You really don't know what you're investing in yet.
I think that's always the issue from our view, is that if we can't really understand what they're investing in, their approach, we would never recommend it to a client ourselves.
Okay.
So I guess, Laura, to sum this up, what would you recommend anyone listening to this, or a client or anyone else would do if they're
if you have money and you want to try it out, it's just like anything else that we would say about any other speculative type of investment. You want to try that, and it's not for the money that you need to live off of, or that you are depending on for another goal. Certainly you could try it out, and you could invest in any one of these, a SPAC or an IPO, or anything that I guess is being traded on Robinhood, or any of those things. But I mean, in all of those cases, there's a large potential for you to get into trouble. So we would recommend to know what you're invested in, and to feel comfortable about what the risk is. And so we always focus on the downside risk. What is the potential worst case scenario of this investment before we're going to invest it? And that's why we would never put clients' money into this, because the worst case is you lose everything.
It's always, it sort of goes back to human behavior. We all hear stories of somebody who hit the lottery, and we all think maybe it could happen to us. But frequently we don't hear the stories about the people who lost their money. We only hear about the winners. And so we think that, I guess it sort of inherently makes us think the odds are higher than they really are, that we can become multimillionaires.
And
something like this.
Yes,
that's right.
Because right now, everything looks great. They're all doing great. It's only when they're not that we then will have a problem.
Yes.
So,
very good.
As always, we're here to answer any questions that you have. Please feel free to let us know if you want further explanation on this or any other investment that you're considering. Thank you. Bye.